Okay, I think we're live. Good evening, everyone. Let me know if you can hear me and see my screen properly. If so, we will proceed to do the needful, which is talk about markets on a Monday. Hope you're all doing well. Finn says all good. Evening. Presumably stuff is working then. Wonderful. Turn up your mic. I'll move it closer. I can promise you that much. There we go. So let's get into it for the benefit of the YouTube audience. If you enjoy Technical Roundup, leave us a like on the video as you're listening to me drone on. Leave us a subscription if you tune in yet are not subscribed. Shame on you. We're going to talk about some resistance levels, but the most important one is the 50k subscribers resistance on this channel. If we can break that, I think anything is possible. So, as the title suggests, we're going to discuss the implications of a crypto trend breakout, or how to approach a trend-forming breakout, if that is what we have on our hands, and the available evidence is favorable in that regard. So, a crypto Greg stream, yeah, okay. So the point is the following, and we'll start with a Coinbase chart just for the benefit of more data, just meta. Essentially, we have undergone a long period of consolidation, so 6 to 9 months, depending on how you want to measure it. And at the moment, we have high time frame evidence of a breakout, which would signify a shift from range-bound conditions into potentially the early stages of trending conditions, right? So the question is, how do we approach that? What are some reasonable expectations? And again, as per the title, the implications of a crypto trend breakout, at the very least with reference to BTC, because the argument is more difficult to make for ETH and almost impossible to make for altcoins, or at least very many altcoins, a large number of them. So this is understandably a Bitcoin-centric discussion we'll be having. I will also hopefully make some time to discuss when/whether altcoins will catch up and some rotation timings. Perhaps that's better suited for the newsletter tomorrow, trletter.com, as well as Altcoin Thursdays, everyone's favorite show. Said facetiously, of course, but lots of focus on BTC today, I think. So as far as making the case, as I've suggested, we have on our hands a prolonged consolidation which now appears to be breaking out. Okay, if we look at similar inflection points in the market where we had either a reclaim or basically a large impulse through a key level, we have a few examples. If we want to take some recent ones, and this isn't by any means a sort of rigorous empirical investigation, this is just to get an understanding. So the 6K break, right? That's an important one. I think the break and, well, basically the COVID crash and this uptrend that followed with the infinite money regime that we all enjoyed is an important one. The 12 to 14K breakout is also important. Alongside, we can add the 20K breakout as part of that trend. And then on the downside, I think the important one is really the 30K, hey, our industry is a massive fraud breakdown. Now, from these, I think a useful question to ask is, with these trend-forming impulses, did the market allow a reasonable amount of time to position for a pullback of some sort prior to trend continuation? And the answer in most cases, I think, is probably not, or at least not as clear as we'd like it to be. So, for example, on the 6K breakdown, we closed below the weekly level and then just went. Okay, I guess another one is basically this trend-forming breakout here. Now that I think of it, the sort of 4K level as well. So you can sort of, it's dealer's choice as to the exact levels. But just again to gain a sort of surface level understanding from a cursory overview, 6K break, close below, impulse. Okay, no pullback, nothing visible, at least on the weekly time frame. 4K breakout, just breakout, consolidation, more breakout, no pullback to the level itself at 4K. What else do we have? So as far as the larger, well, this break and sort of pandemic crash reclaim, once the market got above 6K, which was expected to be unbelievable resistance, but at first instance here. So again, you can find your own examples, sort of the 6K reclaim trend forming breakout, this move here. Actually, now that I'm at this setup, sort of this leg. Did that allow some sort of pullback? Okay, guys, 6K has been reclaimed. Let's get long, wait for a pullback. Absolutely not, right? The number go up. And you can see even we're finding examples within examples of these sort of trend-forming impulses not being particularly charitable to systems which rely on a clear, orderly pullback on a sufficiently high time frame, right? We have the COVID crash here and the subsequent uptrend that was ignited. You could make a tentative case for some sort of pullback, but all the candles are green. And this is just a very weird time in markets. So I think it's a wash at best, but not sort of textbook by any means, I don't think. As far as the 14K breakout goes, that just, closed below, next week close above, and then just goes. 20K breakout, very similar, consolidates at the level. Once you get the pop, it just goes, and so on and so forth. With another example, as far as recent ones, the 30K breakdown, I don't personally see this as much of a retest type of week or candle. I remember writing about it at the time, saying we're still below the level, it's resistance still proven otherwise, but by no means is this something you'd see in CryptoCred, TA, LARP, course, or baby pips or anything of the sort, right? And so again, from a glance at the available evidence, when we've had very significant impulses or trend-forming impulses or breakouts from large consolidations or the market slicing through key levels, whatever terms you want to use, I think it's fair to say that on average, those moves, if you want to catch continuation, aren't terribly kind as far as providing orderly pullbacks, okay? So applying that to our current framework, if it is the case that the mid-20s breakout that we have on our hands across several timeframes, so the weekly here, the monthly as well, trading quite a lot above the levels, on the daily time frame, breaking out from the daily range, however you want to slice it, can we have a confident case that if it is a trend-forming breakout, that the market will allow for an orderly entry before continuation? I think the answer is probably not. Or if you want to be really safe, you might want to have a way to deal with it if that orderly pullback isn't given to you. I'll actually be making a somewhat stronger case that if the market does start to pull back to those breakout levels, that's a reason to be suspicious, if anything. I have this sort of underlying view that really strong trend-forming breakouts, the ones that do offer the type of continuation that we like and want to trade, shouldn't really be pulling back to the origin of the break itself. Is that somewhat intelligible so far? Julian says yes, absolutely. So does Stake. He seems to agree. Fantastic. Okay. So given that, before we discuss how to proceed, I think it's important to make the case, basically the antithesis to this, which is, what if this isn't a trend-forming breakout? What would that look like? What's the invalidation, and so on and so forth? Because essentially, the sort of colloquial, almost pedestrian version of the argument I'm trying to make is, if you consolidate for a while and you break, you'll keep moving in the direction of the break, right? So consolidate for a while, break. If it's a trend-forming break, you don't expect it to just be 1 day, 1 week, or 1 candle. You're expecting this to be the initial impulse and then continuation to follow, right? And the same on the bullish side. If you have the market balanced for a while and then it breaks, if it's a trend-forming break, you don't just get one impulse, it's the precursor to further impulses. Okay, now, what if that doesn't happen? What would that look like? Essentially, just like on any other time frame, any other chart, you would look for evidence of a failed break or the market not being accepted through those range boundaries. And quite helpfully, we have a direct example of that quite recently, which is what happened at the range low. So if we take the lowest close here as our sort of support or range low, doesn't matter whether it's this low, this wick, this body, doesn't really matter, and then this is our range high, we had a very good example of what that looks like when it fails, which is essentially the market breaks the level quite decisively, but instead of offering continuation in the direction of the break, it kind of goes nowhere, and more importantly, resolves in the opposite direction, i.e., isn't accepted beyond the boundaries and then trades back within the boundaries. So it's a two-part process, right? One is no acceptance beyond the boundaries. Two, closes back within the boundaries. So accordingly, if we were to transfer that framework to this breakout, what would give us reasons to be skeptical or bearish or flip bias or to have strong evidence to suggest that this isn't a bullish trend forming breakout? Well, just like this impulse didn't lead anywhere back inside the range, we would expect something similar. This impulse ultimately not leading anywhere, which is step one, but step two is really the more important one, which is falling back within the range, so weekly close below 24.4. Okay? At that point, we can make quite a clear argument that whatever happens here was the failed portion of the breakout, especially if it doesn't travel too much further. But regardless of step one, which is the market doesn't accept those boundaries, as we can see, there can be a fair bit of displacement between the break and the original reclaim. The important trigger, if you will, that quote-unquote confirms the failed break is a close back inside the range boundary, having not been accepted beyond it. So on the weekly time frame, that would be a close back below 24.2, I think would be very bad. Does that make sense so far? I just thought it's better to get the sort of antithesis out of the way before we discuss what's in front of us. The final point I'll make is you put those two things together, which are the following. Premise one is that good trend forming breakouts tend not to pull back. Number two, closing back within the range would be evidence of a failed breakout. Three, the market should, you should have some concerns if market meaningfully pulls back, but especially if the pullback fails, closes back inside. Okay? So let me know if this makes sense. Point number one, good trend forming breakouts, as we discussed, tend not to pull back. Point number two, closing back within the range, as discussed, would be evidence of a failed breakout, and we know that's a reversal signal. And point number three, you should have some concerns, and this is a two-part process. If the market starts to meaningfully pull back, that should already at least raise an eyebrow because of point number one, that good trend-forming breakouts tend not to pull back. So if it really starts to pull back and come close to the level, that doesn't necessarily mean it's bearish, but it should give you pause, because at that point you can make a distinction between this break and other good trend-forming breaks. So that's a sort of early alarm system, if you will. But the second part would be the death knell, essentially, or at least something you definitely don't want to see, which is, especially if the pullback closes back inside, at that point, the odds of it being a trend-forming breakout of any sort are very low, and the odds of it being another version of this are very high. Does that make sense? I'll talk about your questions in just a moment, Steak. Okay, good. Steak asks a very prescient question, which is, what if it touches and gets bought back quickly? I think that's sort of the maximum permissible pullback that you can get is essentially, for lack of a better term, a flash crash into or near the level that gets bought up so aggressively that you almost don't see it. And the sort of volatility vector for that, I think, would have to be FOMC or something in macro, something in TradFi, something really unexpected. So already that wouldn't be great, trading back or close to these levels. But if it does, it absolutely has to get bought back so quickly that even catching that setup should be an impossible feat. Okay? So I guess the short answer there is yes, I think all of these three things are true. As far as if it's really strong, it shouldn't pull back. But if it does, on some sort of illiquid, news-driven, legacy, whatever nonsense, it should be absolutely rapid, almost invisible, right? Just a flash crash wick, and then the market doesn't trade anything close to those levels again if it's strong. Okay? So you want to see like a ton of aggression down there and no hesitation from the market. And even that is an if. Okay? Now, having said that, to talk more about the title, the implications of a crypto trend breakout, there's a list of things that I wish someone had taught me properly if I could go back in my trading career. Unfortunately, most of them I had to discover for myself. The foundation there was built by some awesome FX traders back in the day. But as far as crypto-specific stuff goes, a bunch of that had to be rather self-taught. Now, the lesson there, or one of those lessons, is the following. In a trend-forming impulse, consolidation can be a replacement for a pullback. Okay? So in a trend-forming impulse, consolidation, I don't know why that's capitalized, consolidation can be a replacement for a pullback. So the question becomes, what is a pullback? This is like that Jordan Peterson meme, right? What do you mean by what? What do you mean by is, whatever? But it's important to have, I guess, fluid definitions here because market conditions demand that you do so. So in a trend-forming impulse, consolidation can be a replacement for pullback. And, in chart terms, so for example, if you're dealing with a market that's less aggressive and moves differently, it could be quite reasonable to suggest that, once you have a level that's broken, and you know your market well, that it will often come back and retest those levels before moving a lot further, then this qualifies as a pullback within that specific set of market conditions. However, with trend-forming impulses, it'll often be the case that, as we've discussed, it's actually a red flag and a cause for concern if the market starts to do that. So instead, we settle for consolidation as a replacement to the type of pullback that we're used to. So instead of kind of break, retest, and voila, baby pips, what often happens, as we've seen in the anecdotal examples, for lack of a better term, is you get a break, you get consolidation and low time frame pullback, almost like a cluster, and then you get another impulse. So then if you're looking at this schematic in isolation, you might want to argue that, well, look, the market broke the level, but never really pulled back to retest it. Yes, in sort of purely formal terms, you're correct that there was no pullback to the sort of origin of the break itself, but there was a pullback of sorts. It's just the bar for that is different. So for what qualifies as a pullback, at a certain point, especially with trend-forming impulses, where we know that pulling back is a bit of a red flag and not something we want, consolidation is an appropriate replacement for a larger pullback. Does that make any sense? Okay. Awesome. And that's, I think, essentially what we'll have to contend with BTC USD. That at best / at most, if there's some crazy macro wacky FOMC thing, you'll get a pullback of sorts potentially. Again, if the market digests that as bearish news, maybe you get like an outlier move closer to the level itself. But relying on that, I think, it can't be your only choice, because we know that a lot of the time, if this is a trend forming breakout and it's a good one, you have no guarantee of this. And you don't want your options to be, well, look, it either pulls back or I'm going to do absolutely nothing for weeks and weeks and weeks and weeks. You don't want that to be your decision tree, right? So we have to come up with ways to engage with the market in what could potentially be an early trend forming breakout stage without solely relying on the generosity of some macro wick to let you in. Okay? Now, as discussed, I think, honestly, a good video to watch for this is the Altcoin Thursday video on how to trade trending altcoins, because I basically in that video go over an entire framework of how to trade runaway trends. And so if you've been avoiding Altcoin Thursdays for their ominous market impact, I would recommend you bite your tongue, if you will. Not bite your tongue, what am I trying to say? Stiffen up your upper lip, Is that an idiom? I don't know. English is a very difficult language. Nonetheless, just go watch that video because it gives you a very transferable framework for how to trade things that run away and don't retest. That in another world, that's the alternative title for that video: how to trade things that run away and don't retest. So if you want more concrete, more organized answers to that question, the altcoin video is titled "How to Trade Trending Altcoins." So go watch that. Okay. As far as the current structure we have on BTC USD, one thing you can do, and I don't think it's the worst idea in the world, is to engage with it on a monthly time frame basis, at least as far as your levels go, right? Hopefully, for those of you who've watched more than one video, you'll know that we've been big monthly time frame shills on Technical Roundup, both at monthly resistance and also at monthly support, and it's just a very good time frame. Okay? So if you're looking for sort of directional bias or levels or structure or anything of that nature, I don't think it's the worst idea to just start there and give quite a bit of weight to this time frame because, it works. I think it's one of those res ipsa loquitur situations where the thing speaks for itself, and the monthly time frame certainly needs no introduction as far as its levels prowess goes. With that in mind, if we are in a set of circumstances where we essentially had all these levels and now they're broken, what are the next ones? Quite simply, I think there's a reasonable way to carve out a range from 2021. And it can be done in the following way, which is highest close originally made, lowest close originally made, nice little midpoint, and voila, there you go. And again, I think the weight of the evidence suggests that monthly bodies are much more important than monthly wicks. A lot of the time, you can skip the monthly wicks, and they'll still be valid levels on weekly and daily timeframes. But just to keep the monthly clutter free, I prefer using candle bodies there rather than drawing the bodies and the wicks and all this type of stuff, right? I mean, it really does speak for itself. Retest after deviation, retest, monthly resistance, monthly support. I mean, needs no introduction. So with this view in mind, I love the voice cracks. I'm really excited for puberty. With this in mind, the first monthly trouble area in this breakout is 35K. Okay? If we're going to assume that the monthly time frame is good and valid, and that the market will oscillate between monthly time frame levels as defined by candle bodies, your first meaningful area of a structure is 35K. And the other one, if the trend forming argument is wrong, is a close below 23K. Okay, so those are I think, the relevant monthly levels. The first one, 23, to determine the veracity of the breakout, which at the moment seems in good shape. And the other one is the monthly range low at 35K. There you go. Those are your monthly time frame levels to engage with. Does that make sense? Okay. Honestly, I think you could just stop there if you wanted to. Certainly from a more passive, less active, spot-oriented allocation, if that's your strategy, or your strategy has a lot in common with that, I just think monthly trading BTC USD levels is a pretty good deal, all things considered. I would be better off if I were to do that, I think. But alas, the low time frames beckon. Now, going to the weekly time frame, you get a similar view, not entirely a congruent one, but similar enough, which is the weekly breakout at 24.3. Okay? And then I think look, if you want to use the wicks, that's fine. I think the earliest I'd be comfortable making some argument for weekly structure is here at 29.4, and it's also got sort of 30K round number confluence memes. But if we're talking about real meaty structure, which is a very technical term, I think 32K makes sense. And it also helps because that's more closely aligned with monthly levels as well. That's on the weekly. Now, of course, that begs the question, by definition, this is the most sort of diddling in the middle that it gets, because the breakout level is as far away as the essentially resistance / target level. There's no useful weekly structure here. Okay? So then obviously that begs the question, how do we engage with this thing on the weekly or perhaps even on the daily, absent some sort of technical structure? So again, as a reminder, how to trade trending altcoins, just go watch that video. Probably do a better job than I ever could, even though somehow it is my video. But from a price action perspective, the answer is lower time frame price action. Okay? That doesn't necessarily exclude the weekly. So for example, you could apply your standard price action setups on the weekly time frame with a view to continuation. Initial example, or at least two that come to mind straight off the bat. Let's say that this week closes as an inside week. Or, yeah, let's say next week is an inside week, because technically this week won't qualify because we've spiked above the high, so that wouldn't be an inside week. Let's say whatever happens this week, the next candle is an inside week, which means the low and high of the week are going to be contained within the range that we set this week. And then let's assume this hadn't spiked the high, okay? Let's say this is our this is our sort of weekly candle, and it sort of closed as an inside week. Then what you would do is simply map out inside week high as your range high, and then inside week low as your range low, and then viewing it from the weekly and daily time frame, I think are the appropriate time frames to trade inside week setups. If you were to get a failed, basically inside week failure, so a spike below the inside week low, which is essentially a range, price doesn't accept below it, trades back inside the range, therefore offering you a clear invalidation. So that's your invalidation, be it on the daily or the weekly time frame. The entry is either a close back inside the range or some sort of lower time frame entry trigger on the daily or even intraday if you're very aggressive, to reflect the fact that the market failed to break down and is now back within the range. Now, this is where the sort of bit of nuance comes in. Ordinarily, with inside week setups and any sort of range-bound setups, if you're doing business at one extremity, your target tends to be, yes, the midpoint, but really the other extremity. Okay? So if you were to get an inside week failure trigger, and you establish some sort of long position and are looking for higher prices, in ordinary circumstances, you would target the highs. However, the specific backdrop here isn't just a bog standard inside week setup in the context of a range, and it's all very range bound and consolidation bound. Here, we know that there is a directional bias for this market given the weekly breakout. So to account for that, we make a small adjustment. Yes, we start the setup with the regular parameters of invalidation, entry, etc., but the bit that shifts is the target. So the directional bias allows us to almost sort of forego the first trouble area as far as the range high goes, and instead, given the larger higher time frame view, you use that setup to establish a higher time frame position, assuming that the higher time frames are pointing towards the next higher time frame level. Okay? So I suppose what I'm trying to say is, in the presence of a strong high time frame bias, low time frame / standard setups can be traded as usual, with the important modification that the target can be greater than usual to reflect the existence of said strong high time frame bias. Does that make sense? Now, thankfully, there is... Have I lost the chat? No, I haven't. There is a video that this one bum... Not a video, an article that this one bum wrote in 2019. I wouldn't listen to him for much. There's a duck on the internet that does everything better. Nonetheless, this does exist, an article on directional bias. if you have no idea how to make any sense of what this means, strong high time frame bias, modifications, adjusting targets, there is an attempt to make sense of it, which basically drones on about that. So I think if you just Google CRED directional bias, this will come up, and then it's okay. What is directional bias? Constant versus situational, and this is the section that I'm sort of borrowing from, for lack of a better term. How directional bias affects trade selection and trade management. Okay, so that's if you go have a read of that. I guess that, you know, just go do some homework. There's a video on the Technical Roundup channel which talks about how to trade trending altcoins. That will answer your questions. You will have other questions, and there's a good chance they will be answered in this article. And so in doing so, I've made myself completely redundant. Okay, fantastic. So that's just one example. Another example, which is also covered in the altcoin video, is a sort of weekly/daily open setup, right? So let's say you map out contextually the weekly open, and I wouldn't do this in this exact scenario because it didn't set up particularly well, but it's certainly something to look for, both on the weekly and the daily time frame. I know I still need to do the... I'm not going to click on this. I still need to publish the daily open and weekly open strategy video, but essentially, this is the kind of stuff that it was intended for, where let's say this is a well-executed weekly open drive. It isn't, but let's suppose it were one. You have a directional bias, you have a weekly or daily open. Ordinarily, if you have a bullish bias, what you want to see is the following. So this is your high time frame open, be it the weekly or the daily. For bias, we're going to say it's a bullish bias, right? Up. And then what you want to see at the open is ideally a strong drive against the bias of your choice. It helps if there's some sort of structure, support, evidence of absorption, whatever. Let the market do what it may. In this case, let's just get rid of that box and let's say this is our drive into something relevant. And then, you know, eventually starts to bottom out, whatever. And then reclaims and strongly trades above that same high time frame open. Now, even though we don't really have clear support resistance levels available to us, just like we discussed on the weekly, we now at least have some levels to work with. And you'd normally be doing this on, let's say, I mean, I normally do it on either the 5-minute or the hourly, depending on if it's a daily open drive, weekly open drive, so on and so forth. If it's a weekly open drive, honestly, a lot of the time I'm on sort of H4 to day 1. Okay, so daily open, weekly open. Okay, these are our time frames. And so what you want to see is a high time frame open, a drive against the direction of your bias. Ideally, the market hits support on a lower time frame or just gets absorbed, or you see something good down here from your understanding of price action. The important part is reclaiming the high time frame open, so the market trading back above it, ideally within these time frames. And then suddenly you have levels to work with, because your entry trigger area or level is the high time frame open. Your invalidation is the lowest low made on a bullish, well, sort of on a drive down in a bullish case, or the highest high made on a drive up in a bearish case. And then your target is simply the high time frame level for continuation. Okay, so in this case, 28.30, whatever it may be. So by looking at these high time frame opens, and again, this only works if the context is appropriate and if the drive is good and all this other stuff that I'll cover in the video, but just to give you an understanding of the type of stuff I'll be looking for. Even though it may seem that there are no levels to work with, by looking at these high time frame opens, not only do we have levels to work with, the opens themselves, but we can set up trade parameters as we ordinarily would, because we have an invalidation if it's a drive higher in the bearish case or a drive lower in the bullish case. And also, not only do we have standard sort of trouble areas to give us adequate risk reward for our systems, but just like in the inside week scenario, our targets aren't ordinary targets. Our targets are reflective of the fact that there is a high time frame dominant trend / bias, and so they would be higher than they would ordinarily be if you're bullish, and lower than they would ordinarily be if you're bearish, to reflect the fact that the good levels aren't anywhere near here, and we're just trying to catch a piece of the pie before the trending move continues. Does that make any sense? Okay, awesome. I see a thumbs up from Slant. Thank you. It's very kind. You'd still potentially use daily open for a weekly breakout? Potentially. Yes, potentially. I think that's all the pedagogical stuff that I wanted to cover. That's a real word, right? Because I've said it before and no one's ever called me up on it. Pedagogical. Yes. Relating to teaching. Okay, fine. I'm not making up words. That's helpful. Excellent. Cool. Now, as far as market commentary goes, realistically, if the market is going to be anything other than a piece of shit that gives a scary pullback, I think it would be a good sign, given we're still decently close to the breakout level, if we have a regime where daily clusters are respected. My definition of a cluster is a mini range formed between impulsive legs, which usually, depending on the time frame, are these 1 to 2 candle pause consolidations. Okay, that's all I mean there. On this occasion, the nearest, well, there are a couple of potential daily clusters. One is obviously the one at 24s. The issue there is we run into the problem that if the market starts coming back there, our trend-forming breakout thesis looks a bit uncomfortable, with the exception that some sort of flash crash, wick, FOMC bullshit thing. That's fine. But if the market has to retrace this entire move, you know, the bull validating move has to come back to quote-unquote test support, we know that we don't like that. So it's okay, it's fine, maybe for a stink bid flash crash type of thing, but structurally, if we are in the early innings of a trend-forming breakout, it shouldn't really be spending much time here at all. What's our next best candidate? I think it's rather self-evident that it's this daily cluster here. Okay. There. That. So, just to prove the point, as I said, clusters are simply mini ranges that are made more visible and easier to identify on the higher timeframes-ish. And as you can tell, in this general area, what we had was essentially a range. That's all it is. There's nothing magical or crazy or spectacular about, oh, he's drawn a cluster, this candle, this box, whatever. The nomenclature is a distraction at best. A marketing tool, I think, is a better term for it. But that's all it is. We're just mapping out lower time frame consolidations on higher time frames. And so accordingly, the helpful part of knowing that clusters are ranges is that you can apply your standard range trading knowledge as you would on any other occasion. So that means you like to do business at the extremities, at the range high, at the range low. If you're trading in tandem with your directional bias, the acceptable setups are either finding support and or failing to break down at the range low, or I suppose, finding strength and flipping the range high. That's all there is to it. So in the short to medium term, and again, personally, I wouldn't trade into FOMC unless you have high confidence in doing so, especially with the market structure that we have at the moment. Purely in terms of levels, I like to think something is better than nothing, and this daily cluster is something and isn't nothing. Now, exactly how price will unfold from this point, if I knew that, I wouldn't be making YouTube videos, right? Is it just, you know, FOMC is bullish and straight continuation to the moon? Do we come back and retest? Do we close the daily around here and then spike previous day's low into the bottom of the cluster and then close above and then moon? Does it come in and actually spike this low but ultimately close above the bottom of the cluster? I don't bloody know. But it's not my job to know that in advance, as long as I know the areas where I want to do business and know what it would take to execute therein. That's really the important part. Not to guess every single possible outcome. So that's really it as far as BTC USD structure goes for where the market is right now. FOMC is probably going to be a volatility vector, catalyst, whatever, simply because the financial system is tits up. The banking sector specifically, the ranges that are being discussed and debated by economists as far as 50 points, 25 points, a pause, a cut. I mean, there's no consensus whatsoever. And also, contextually speaking, we're starting to reach an area where some technical selling and or profit taking may take place. And that's simply because we have some semblance of daily structure here on the underside of 28, 29, as well as sort of mechanistically front-running 30K, I think is a decent part of the reason we've just slowed down a couple, at least over the course of today. Okay, so there is some structure here. Is it as good or as compelling or as much of a magnet, if you will, as the monthly and weekly structure? I don't think so. If we're trading this intraday, is it still relevant? There's stuff here, yes, especially if there's news to go with it. Okay? And so this is, I mean, what have I got? I don't think I've got anything different really on my mark chart. I've just got the weekly open. I have a latent understanding that there's a cluster here, and I have again a latent understanding that there is this level, but nothing too dissimilar. Okay. Also, I'm just as a complete aside, totally off topic. Recently, my trading's been rather hilarious. Did I say training or trading? I guess both have been quite funny. But on the trading side, essentially I've turned into this, where the market will do this. I'll miss out the entire thing, but then it'll do like a bit of this, and I'll have the best trading session ever. And then it'll do this, and I miss all of it again. And then it'll do like a bit of this, and I make a shit ton of money. And then it does this, and so on and so forth. It's been hilarious. Like this trading range for me, I'm like 4 for 4, I think. Either 3 for 3 or 4 for 4. No, 4 for 4 now after today. Yes. So like I love trading this on the intradays. To me, this is paradise. Like price action is so clean. I absolutely love it. You know, DGen-Cred is down on the 5-minute smacking this thing. And I've had an absolute joyride with it. But I've still massively underperformed the market because it's up like 60% from the lows and I've done fuck all. Or at least the fuck all that, you know, the more than fuck all that I've done is less profitable than just buying that low and holding it. But still, quite funny. Any questions about BTC USD and those clusters and all the other stuff? Hindsight analysis, I mean, realistically, 3 of the 4 trades were simply punting this range here. That's it. This. Support resistance. Like literally this. Here. So men will miss this entire move and then trade this profitably instead of going to therapy. Meanwhile, Don just goes like all in here and now is on the beach with his girlfriend. And somehow we share a channel. Oh, man. Good heavens. So yeah, I think that's the only useful commentary I've got for BTC USD as far as this goes. Don't get rugged by FOMC. Be aware of this area-ish. watch your daily clusters and treat them like a range as you ordinarily would. If it gets flash, crashy, wick, something very unstable and bearish, it really shouldn't be spending close to any time at all to these pullback levels. It should be very, very quick. Any stalling or consolidation or, oh, we're going to close around here and retest for a few days, all of that is nonsense, okay? Either aggressive continuation from closer by structure, or if it's deeper structure, it should be bid up unbelievably aggressively and end up trading at the earlier structure almost immediately, okay? It's great having two contrasting traders in one channel. Yeah, one good one, one shit one. Gotta love a bit of contrast. Yin and yang, right? I think that's how that works. If we get a retest wick, that's a gift from the heavens, says Private P. I think I agree, but that's also why it shouldn't be your only scenario, because the market doesn't owe you that. What is your favorite sandwich? What, are we talking Subway or in general? Turkey breast and ham, I think. Bunch of veggies in there. Okay, that's really it for BTC USD. And again, you can do the same exercise on the 4 hour. Like, for example, if we have this daily cluster here, if you look on the 4 hour, that has some overlap with this mini range that we had. And then if you start to think, well, if the daily is going to wick, where could it wick to? Well, you know, you've got at the bottom of this 4 hour cluster, you know, you can take it as far as you like. But overall, I think the structures are decent. Decent enough. Did you drink a monster with Sats when you met him? Not with him, but I have been unduly influenced into a higher monster consumption than prior to meeting him. So, yeah, that's BTC. As far as ETH goes, honestly, I haven't been thinking too much about ETH because the market's been entirely Bitcoin-centric. So the entire discussion of trend-forming breakouts, you can't even, in good faith, apply that to ETH USD in its current form. Because while it did break out from this consolidation, it doesn't have the same thing as BTC, where it's clearly smashed everything, and now you're just sort of waiting or trying to catch a piece of it. I mean, you have levels on ETH, right? There are relevant market structure levels on ETH that have been that are so far untamed. So that makes it quite distinct, I think. And I think that is also best evidenced by... I don't like using evidenced as a verb. I feel like it's so lazy and such messy English. Best evidenced. Ugh. The best evidence for that is on the weekly chart. This is from an earlier show. Because, you know, I'm a professional, unpaid content creator. We were doing weekly open earlier. But I do think fundamentally... I say fundamentally, I'm about to talk about technical levels. I do think these levels are good on ETH BTC, where, yes, the whole thing is range-bound and it's rubbish, but we finally had a weekly impulse through a key level. So if you want to risk on ETH and or altcoins, I think you want this thing to look a bit more constructive, because at the moment, it went sideways for all this time, and then just broke market structure last week. So that's an impulse that I wouldn't fade without good reason. Now, what would qualify as good reason? I think if the breakdown fails and above 0.66, that's okay. If it hits support, the range low at 56s, 55s, that's okay. And, you know, basically gets rescued within this consolidation. I think maybe we get a bit of relief on ETH and probably altcoins to go with it. But for the time being, I do want to stress the argument made initially that this is a very, very Bitcoin-centric market. And you can tell just by how much alts are getting absolutely slammed, with BTC only 0.5% below its daily open, right? And even in terms of price performance, if you were to look at most altcoins on their alt BTC pairs, you are not beating the market by holding them. Even narratively, as far as bank stress, it's all about BTC. So I think this definitely demands your attention. And I would also say it's a good thing. You know, like in the past on this channel, to great effect, we've discussed the implications of having rallies that aren't Bitcoin oriented, or where Bitcoin lags significantly or doesn't participate at all, or where it's really frothy altcoins, and then BTC does nothing. All of those things are negative. So now that we've got the inverse of that, where it's entirely Bitcoin centric with a real narrative, or at least a compelling narrative as far as, you know, banking and all that type of stuff goes, that's fine, because the expectation is that I'd rather the strong buyers come in to the big assets that are not far out on the risk curve, and then once they've made a shit ton of money and there's a bunch of profit and volatility dies down, they consolidate that to shittier assets further out on the risk curve. Because you can't sort of go the other way. It's not like you get alt season and all the garbage pumps, and then, hey, all the garbage profits are going to go back into BTC. I don't think it works that way mechanistically. It's much more consistent to have the big caps, especially BTC and ETH, go first, and then it's much more intuitive and straightforward for those profits to rotate elsewhere when price action allows it to do so, which is generally either consolidation or some other form of lower volatility, as long as it's not too bad. Okay? So, yeah. I should also say, though, on the narrative point, a narrative is only as good as the price action supporting it, to be frank. So there's a lot of synergy now between Bitcoin's performance just this year so far, this breakout, the continued bank headlines, and how this market has looked. That's a very good thing, but it will evaporate pretty quickly if price doesn't play ball. So don't expect the narrative to bail out the price, I suppose, is what I'm trying to say. If price starts shitting, then, you know, if this turns into some sort of deviation, then no one's going to be calling Bitcoin the anti-bank asset if it starts crapping the bed. So I completely agree that it's very helpful that both are working in tandem and, again, synergistic. That you have strong price plus narrative, and that creates a sort of almost circular flywheel effect where one feeds into the other. All of that is awesome. But don't assume that the narrative part will stay around if the price doesn't keep up. Bernd says, over 400 viewers and only 151 likes. I know. So upsetting. My fragile male ego and sensibilities as a washed-up influencer are in shambles. But there we are. That's all I want to talk about, really. I won't keep you for any longer. For those of you who enjoy these short Monday market videos, my apologies for the live stream, I guess. But you can click around, and next week we'll be back to normal scheduling. I've hopefully left you some homework to do. I don't mean that in a patronizing way by any means, just words. But the how to trade trending altcoins video is very good and may continue to be good for these conditions. I know that sounded self-indulgent. I guess by good, I mean pertinent? Is that a word? Hold on. Let me Google it. Pertinent. Relevant or applicable to a particular matter. Yeah. So the altcoin trending video is pertinent, potentially pertinent to present conditions. And then the directional bias article is also relevant for adjusting lower time frame trade parameters in the presence of a high time frame directional bias. So if you go do those two things, I think you'll be in good shape. Or alternatively, just don't fucking watch Monday markets and go listen to Don once a week, and you'll also be at the beach with your girlfriend. That's all from me. If you enjoy altcoin Thursdays and Monday markets and technical roundup, or you know what, I might as well keep you hostage here. If you like DonAlt, which you should, he will be very happy if we breach 50,000 subscribers and if you were to leave a like on the video. The truth is, he really doesn't care at this point. He's so checked out and so comfortable, and there's not a care in the world, I think, as far as shitty chart content. But I will simply use him as a human shield to harvest your engagement. So like the video, subscribe, do all that stuff. Go to trletter.com, sign up to our newsletter where we basically write down Don's ideas. And yeah, thank you for watching, and hope you all have an excellent start to the week. Don't blow up on FOMC tomorrow. If you can do that, I'm proud of you. That's all from me, and see you at some point later. Thank you. Bye-bye.